Hi, this is our Forex blog for February 19th, 2013. And like I said before, I'm going to try to do 2 or 3 blog videos a week, going back the last 2 years. Pretty much 99% of the time I did them every day. But, with a newborn at our house, plus other things I'm dealing with, working on automated systems, um, I don't have time to do these blogs every day. But one of the easiest ways of trading, and there's literally hundreds of ways to trade, but the key is small losses, big wins. Don't worry about the winning percentage. Some days you might only be right 1 out of 3 times, but if you catch a 50 pip win and you have 20% break even trades and your average loss is 5 or 6 7 pips, you still end up with money, and that's what it's all about. Too many new traders especially are too concerned about the winning percentage. I have one trader who was not trading with our methods, but he took like 1,000 pip loss. But his other trades were 2 or 3 pip wins. Well, guess what? He was over 90% winning, but he lost, wiped his account out. So don't worry about nonsense stuff like winning percentage. Just worry about whether a system makes money or not, and the expectancy of your system. So I think one of the easiest ways of trading is just using our indexes. We have an index for every single major pair or individual currency, the dollar, the yen. And this is, we've actually created a chart that shows what the dollar is doing versus all the rest of them in chart format. So you can see, when a currency comes down and finds support at the previous day's low, and you can see the daily, weekly, monthly trend on the bottom. If it holds there and the longer term trend's up, you might want to consider buying the lows. As you can see, it went up. And then it found resistance at the point of control the previous day. This is market profile technology, which is, it basically tells you where most traders have positions in all the dollar pairs. Sometimes it's in the middle of yesterday's range, sometimes it's right at or even exactly at the low. And of course, it can be near the high or anywhere in between. As you can see with different currencies, this one's slightly below halfway. The Swiss is in the middle. Look at the CAD here, or the Australian. The point of control is really close to the low in this case. That's where most traders had positions yesterday in the Australian. So it's a very key support resistance. Sorry, I was about to sneeze there. All right, so basically, in a nutshell, you want to find strong currencies to buy and weak currencies to sell. So I'm going to go through each of these, and we're going to look at certain events like breaking down from above to below the previous day's low. That's a very key event, and when the markets do that, most of the time you're going to get 20 to 50 pip moves. This was a false breakout, but you can see at 3:30 the dollar became weak, and then again at 11:30. So we'll put that on here. W for week, and there's not much other significant events in that particular currency. This one, the yen, was above its hourly, above its 15-minute. Unfortunately, the weekly monthly trend are down, so that's the only downside here. But it came up to the previous day's high twice, and then it broke through. That's a very significant event. So we'll look at that at 2:30 right there. The yen was quite strong. And basically all you want to do is find a strong currency to trade against a weak one. For instance, the euro is underneath its hourly here, and it breaks down underneath the low here and here. It cannot stay low. You can see kind of a head and shoulders pattern on the bottom here. It breaks out, and when it's above its point of control, above the hourly, above the 15, and especially when the weekly trend shifts to slightly uptrend, you have a nice, beautiful, high probability trade right here with a wedge pattern. Low volatility patterns are very high probability using our indexes. So this was one of the higher probability trades all day at 11. So this one's strong. So you can see that the dollar was weak at 11. So let's start by bringing up just I'm just showing for illustrative purposes on a 5-minute chart. I personally use range charts, 5 pips per bar. But then they have to download tick data, and I don't feel like waiting for that for the blog video here. So notice the chart here at 11 o'clock. The dollar was weak, we already know by looking at the index. The euro became strong on the index. And you also have a very similar looking pattern here. And you can draw your fibs off the previous swing. and you know where your profit target is. And in a nutshell, when you buy this breakout right here, your risk when you buy somewhere around 33.60 would be a few pips underneath the low down here. So even before you take the trade, you know your risk is about that much. That's it. And your likely profit is from here up to the fib target. And if you take a look at that, let's just make these wider. Oops, I'll just even make it bigger. It doesn't even matter, just to move it over. You can see your profit is about 2.5 times the increased distance here. If I make it back to the size, its original size here, you can see it's a 3 times bigger likely profit than what your risk is. And that's the key to trading. The only key to trading. It's the only thing that matters. You might have a loss, 2 losses, sometimes even 3 losses in a row, and then you have, you know, one nice win that gets rid of all 3 of your losses, plus leaves you with 15 to 30 extra pips. All right. And also, when you use our indexes, look at the statistical trend at the time. This shows you what all of the currencies are doing together statistically. So any move at and above 40 is pretty strong. It's likely to continue. Any move up with 40 strength followed by the pullback with 1/2 or less visually, you can see that was 1/4 or even less than 1/4 of this strength. That's a no-brainer trade. It doesn't get any better than that. So let's look at some of the other ones. Here's the pound, and it broke down from above the hourly to below it, and it had a breakdown underneath the previous day's low here and here. Let's just start looking for shorts at 8 o'clock onward, and let's find a currency that was strong at 8 o'clock. Here's 8 o'clock. This one, had been trending up. It's above its hourly. It's above the previous day's high. More than likely, the pound yen is going to be an excellent one to be buying after 8 o'clock. I'm sorry, not buying, selling. Weak pound, strong yen. So here's 8 o'clock right here. We're looking for sells. And like I said before, if you got short right there and your stop was right above the high, and you use the trailing stop, you might have lost 7, 8 pips on here. If you got short again right here, you might have, when it went above the high here, lost 12 pips. But then the third pullback trade, when it breaks the trend line, you go short, and we can put the simple moving trailing stop on here, chandelier stop. I like to use the 2 times ones, but again, I use range charts. So, but even if you look at this, and we'll zoom in on that trade here. You get short right when it broke the low here at 59. The first stop we're out at 59, so you pretty much broke even on the first trade. In fact, the first trade you weren't out till here, and the second trade you got in somewhere around 86 and got out at 43, so you made 40 pips. So you pretty much had a break even plus 40. Again, you can also get down to a 5-bar chart, which is 5 pips per bar, and it gets rid of a lot of the noise. On this chart at 8 o'clock, we're short. You can see you would have actually made a few pips on that one. I like to pretty much go short after, and I prefer on most pairs 12 to 15 pip pullback. Pound yen is more volatile. You might want to wait for 20 or 25 pips, so that wouldn't have been a deep enough pullback to get in that. But you might have gone short right here, and you can see the trailing stop still above it. With your stop above here, you might have had a small loss. You got short again right here. You might have made 5 pips, short again, small profit, and then eventually when the trade worked, you have an astronomical win from 90 all the way down to 30. You made 60 pips on this in the final move. So the only thing I don't like about the range charts is you might have to tinker with the chandelier, because some currencies are more choppy than others. Maybe 2.5 to 3 times volatility would get you, have fewer trades and less whipsaws. But the point is, you use our new indexes for each currency to find events that are significant. One thing significant here is yesterday, most of the pound traded at in near its lows all day, or the point of control wouldn't be here. It wasn't, the point of control is not in the middle. So you can see that this price, it pretty much spent most of its time at that level. And so there was a lot of trades you could have done today. You could have got short when it went from above to below the point of control, because look at the weekly and monthly trend, it's extremely weak. Or when it came back up here, right underneath the 15-minute moving average, right underneath the hourly, couldn't bust through that. When it finally breaks down here after trying to go above, you go short around 10, and you would have got into this trade, you know, a lot earlier. So let's look for some of the other events. Here, the Swiss broke down from above to below the previous day's low. Notice how the point of control acts as amazing resistance here. Anytime a key support resistance area holds for 30 minutes or longer and then finally breaks, that's a very high probability. Same thing here happened at the hourly. Tried to bust through the hourly earlier, couldn't do it. Tried it again here. When it finally broke through those lows, 5-6 hour lows, very high probability place to go short at 2. Let's see what was a strong one at 2. Yeah, this one a little bit after 2, the yen, remember, got strong. So a Swiss yen short at 2, very high probability. It doesn't take a rocket scientist to figure this stuff out. So here's the 2 o'clock. It actually, the trade happened at 2:10, so you actually had 10 minutes head start. Notice Jerry Fibs on the last swing, and you can see your risk was maybe about 10 pips. Your profit target in this was about 20 pips. It's a 2 times bigger profit than what your risk is, and that's all you really got to look at and focus with. Here's the CAD, and this one was underneath its hourly, couldn't get back above it, and then broke down and made new lows here at 230. We know that the yen was one of the stronger ones, so we will sell the CAD yen around 230. Let's scroll back and look. Again, you had quite a bit of notice here. This thing broke down from 92.60 and got all the way down to 30 and fell 30 pips. And if you want to go to 5 pips per bar chart, you can also possibly get into some of these trades a little earlier. For instance, a lot of times when you have up down bars, 4 or 5 of them in a row, when they break down, you can go short, especially if a currency is this weak. And so you're risking literally 5 pips plus 1 pip above that, plus whatever the spread is. So it's almost always under 10 pips total risk. And anytime you get into a trade you're not sure about, move your stop in half after it goes 5-6 pips your way, and break even once it goes 8 to 15 pips your way. And always know where your fib target is. I tend to exit half of my trade at the fib target, and then the other half when it's either chopping up and down like this, or sometimes when it hits the trailing stop. And that's it. Let's take a look at the Australian. This one, exploded up late yesterday, went sideways for 6-7 hours, and then busted through and made new highs. So at 3 o'clock here or so, 3:30, the Australian is very strong. You can see the weekly trend shifted up. Let's find one that was weak at 3:30. At 3:30, the dollar's near its lows. So it makes sense to buy the Australian dollar. I'm going to go back to a 5-minute chart just because it comes out faster. You want to buy the Australian dollar at 3:30 when it breaks out and makes new highs. Now this is probably the worst looking trade of the day because the dollar really failed to break down. But you can see you probably didn't lose anything on it, and that's pretty much all that matters. You bought that trade right here, it never hit your trailing stop, it hit your profit target. You might have made 8 or 9 pips on the first half, and then pretty much made 2 pips on the second half. But you can see the dollar found support here to lows and kind of drifted up. So if you traded the Australian against the weakest one, let's find another one that's maybe hopefully weaker. Yeah, this one was trending down. The Australian Swiss would have been an excellent one to be looking to buy at 3:30. You can see this one went up 10, 20, 25 pips. That's a little better. Yeah, the CAD was probably the weakest one. So we buy the Australian CAD. Remember 3:30. Went from 450 all the way up to 85. So 30, 35 pip win. Or if you took this trade here and when it went sideways, you got out with 10, 12 pips. You bought it again here, made 10 pips. You buy, anytime it finds support for hours and breaks out, very high probability because the trend is up. You can see it went from 65 to 80 in about an hour and a half. These are all trades that you can take using our indexes and, of course, our FX trend intensity, which measures statistically how strong or weak each move is. Those are some of the highest probability. When you see a move that falls with a lot of weakness and then gradually drifts up without that much strength, half or less visually, you look to sell it, especially when it's underneath the previous day's low. So 11 o'clock right here, excellent place to be looking to sell the CAD. So let's find a strong one at 11 o'clock. Certainly wasn't this one. Yeah, 11 o'clock, the euro was one of the stronger ones. If you were trading at 11 o'clock, you would have bought the euro CAD. And as you can see, 11 o'clock, this one pretty much broke out from this little pullback. It had a false breakdown and immediately came back up. This is called a railroad track pattern. It's one of DiNapoli's patterns in his books. And you can see it went from 35.20 all the way up to 60. 40 pip move in about an hour and a half. Again, it's that simple.